Hello, everyone. Welcome to this edition of the African Financial Industry Summit. Thank you very much for your time this afternoon. We're just waiting just a little bit for a lot more people to come into the room, and we'll start in the next 10 seconds. All right. Welcome, everyone. Thank you very much for your time and your attention this afternoon. Welcome to our latest edition, the first for 2022 of the African Financial Industry Summit events. These are a series of webinars that we've been holding over the past year or so, covering a bunch of different topics related to how our economies are working pretty much right across this lovely continent of ours. We've covered everything from mobile money. We've spoken about boosting cross-continental trade. But today we're going to be focusing specifically on the question of affordable housing. This is part, of course, of a wider series of events that we've been holding for a couple of months now. But first, I would like to remind you that we're having our key event, our flagship event, that's happening a little later on in the year, in the middle of June, the 13th and the 14th of June in Abidjan. That's where the Africa CEO Forum is going to be taking place in person. And of course, it's going to be a bit of a virtual and hybrid event. So please do register for this. You can do that through the QR code that's on your screen at the moment. Alternatively, you can head over to the website, Africa CEO Forum, theafricaceoforum.com. That'll certainly get you all the details that you need to know in order to be able to register for this event. And after the last 2 years, it will be fantastic to see everyone in the same room once again. My name is Ramanyang. I'm a business journalist with CGTN Africa, based in Nairobi, but we go wherever the work takes us across Africa, and there's plenty of stuff that we do cover right across the continent. I'll be your moderator for this particular event and this conversation for the next hour and a bit. Just a couple of housekeeping rules to go through as we start the event. There's a Q&A button that you do have at the bottom of your screens. In the event that you do have questions for our speakers, our expert presenters, please put in your questions over there. Myself and the team running this event will be able to see them. Alternatively, if you also have any problems that you're having, if audio is breaking up, if you're not able to hear one of us, one of the speakers, also, again, please let us know using the Q&A section at the bottom of your screen as well. This being a digital event, you will be engaging on Twitter. We'll also be gathering your feedback, your thoughts and ideas from there as well. The hashtag to use is AFIS Digital Events. AFIS Digital Events, that's the hashtag that we're using, not just for this event, but for the entire webinar series as well. I'd just like to give you a very brief overview of the individuals that you'll be hearing from, that we'll be talking to in the course of the hour. We'll have, of course, Maureen Katube-Sirawina from IFC, a global housing specialist. She'll be handling our expert presentation. We'll be hearing from Femi Adewale. He's the Managing Director and CEO of the Family Homes Funds. Kisia Russ, the Executive Director of the Center for Affordable Housing Finance in Africa. We have Kaise Mashifane, the Executive in charge of Residential Property Finance over at Nedbank, and Christian Agosa, the CEO of a mortgage refinancing firm based in Togo. We'll also be hearing in the course of the conversation from Dina El Kadri, the founder and executive director of Alpha DigiCredit. This is the brain trust for this particular event today, and let's just get right into it, shall we? Maureen, you're our housing experts. Lay the groundwork for us. What should we expect today? I think you're still on mute, Maureen.
Thank you, Rama. Thank you for that kind introduction. Thank you for having me. I'm delighted to be part of this webinar today to kickstart off the conversation, highlighting some of the challenges and opportunities of Africa's housing sector. So the African housing finance market is dynamic, different in each country. However, there are similarities when it comes to the challenges facing the sector, such as the fragile and poorly regulated enabling environment, lack of long-term capital, specifically local currency, small capital markets with a lack of diverse investor base, and viable secondary markets. Also, the sector is facing high interest rates, high inflation rates, and existing yield caps crowding out the private sector. So these are just some of the high level challenges to kickstart off the conversation. If we can go to the first slide of the presentation, we appreciate that. Some key numbers that are facing the sectors or data that we can all take home today is 54 million of the population of Africa are living in slum. And this number is expected to double by 2030. So we should be very concerned about that if we're not doing anything in the affordable housing segment. And housing deficit is enormous on the continent. We have about 56 million units in terms of deficit. And Nigeria takes about 17 million of that housing deficit. Whereas when I take you to East Africa in Kenya, we have about 2 million of that deficit with an annual housing deficit of 250,000 units. And the market is only able to supply about 50,000 units. And from that 50,000 units, only 2%, under 1,000 units, comes into the market for the affordable segment. That's again a really major concern for us. In South Africa, we have about 2.8 million deficit for housing units to be able to really close the gap of the housing deficit for these markets. In terms of affordability, the majority of Africans are working in the informal sector, and that makes them difficult for them to access mortgage financing and housing loans. And the data says that about 74% are in the low income bracket and less than $2 per day. So that's also some of the things that we need to look at when we are adapting or developing various housing strategies or to really tackle the affordable housing segment on the continent. When it comes also to affordable housing, about 1.6 billion people will struggle to secure adequate housing by 2030. And it is projected that 90% of this number, the 1.6 billion, are going to be in Africa and Asia. When it comes to tenant insecurity, 70% of land in emerging economies are unregistered. So that makes it difficult for financial institutions to come around the table and issue mortgages. Another enabling environment also that we need to look at in various countries is when it comes to delivery, enabling environment of constructing these affordable homes, there are certain bottlenecks such as the number of days it takes to approve a construction permit. In Africa, it is estimated it's about 172 days, whereas in OECD countries, it's about roughly 76 days. So this is just like high levels, significant challenges facing the sector in Africa. If we can go to the second slide, please. So we also seeing not only challenges, but there are also opportunities or trends that we are witnessing in these various African markets. The cities are growing with high urbanization rate of about 4.1% in sub-Saharan Africa. And then more than half of African population live in slums, mostly in urban locations. So we also see densification increasing. And then also blockchain and technology is coming into the market. And there's a lot of innovations taking place in terms of construction methods to bring down affordability of these affordable housing or the segment. And one of the things also that is one of the greatest development challenge is climate change. We're seeing a lot of innovations around green buildings, around financial institutions and developers developing financing construction of green buildings that will ultimately bring down the costs for the end users of these houses. So that's one key great innovation on the continent. And we're seeing a lot of also fintechs coming into the place to improve efficiency in mortgage distribution. Next slide, please. So addressing these challenges requires a sustained commitment and support, and it is both from the demand and the supply side. So one of the key challenges on the supply side alone in the African market, we're seeing that developers are small, fragmented, and lack financial and technical capacity to deliver scalable projects. We're also seeing a lack of infrastructure services such as roads, water, sanitation, and electricity. And the cost of building materials is also high, which trickles down to the affordability of homes for the low and middle income segment on the continent. And on the demand side, we have a low purchasing power. About 74% of the percentage that I have highlighted in the previous slide, that and their incomes from the informal segment and are really unable to afford some of these houses that are coming into the market, and also leads to access for mortgages that are affordable. And touching on the high interest rate in Africa, and also high registration costs for properties also lead to some of these type of segment to be affected. And mortgages are inaccessible in many of our markets. We witnessing a lot of markets that are nascent, where interest rate is very high, and people are just not able to afford or to access these mortgages. And then we are seeing also an emergence of rental housing or rent-to-own initiatives or schemes that are coming into the market. So there is a bit of lack of adequate rental housing in the market, and that could be something that the housing or industry experts can look at, how we can develop the rental or rent-to-own schemes in some of these markets to really address affordable housing challenges. Next slide. This slide is going to give us just a perspective when we say that the mortgage market is nascent or undeveloped or inexistent in Africa. We are seeing mortgage interest rates in certain markets like Ghana, Nigeria, which is above a single digit, around 18%, which is a concern. And those are those countries where we have huge populations. The moment you have such high interest rate, it becomes just inaccessible for the majority of people on the continent. And they are unable to afford mortgages, they are unable to access housing. The good thing that we are also seeing in some of these markets is the extension of longer tenor for mortgages. So if we can all get there, it will be able to bring down affordability. We're seeing in the YMO region where interest rates are around 7%, and the tenor of mortgages are around between 15 and 20%. So that's encouraging results on the continent. Also, when you come to comparing the development of the markets, we're seeing that big countries such as Nigeria, Ethiopia, their mortgage ratio to GDP is under 1% or under 2%, which means that there is room for development, or there is room for more work to be done to develop those markets. A lot of workers are coming into the market. Femi will talk about the initiatives that Family Homes in Nigeria is undertaking, which is really dynamic and changing the market in terms of really targeting the majority or the bulk of the African people that require housing and mortgages. So when you look at the markets that are a bit in not developed, but they have a mortgage ratio to GDP about 10%, which South Africa, Tunis, and Namibia. So that doesn't say like those markets does not have their own challenges. They do have their challenges. Keisha will talk about these, what has worked well or what has not worked well in South Africa. when it comes to the mortgage market development. We see they have a high mortgage ratio, but the mortgage numbers are just not increasing. They have stagnated for a couple of years. In terms of the quality of the housing assets on the continent, we are seeing a lot of improvement, like in the Southern Africa, seeing NPLs trending below 5%, whereas in Kenya, it is around 12%, and Ghana, Nigeria, again, it's about in a range between 18 and 20%, and Cameroon is 24%. These NPLs are driven by different factors and characteristics of the markets. For example, in Cameroon, the only institution issuing mortgages is Credit Foncier, and they have about above 20% of these bad quality assets. Whereas in Ghana, it's a mix, and Nigeria, but the majority of these non-performing assets are not in the affordable segment, but majorly in the upper middle income or high-end segment, which is also something worth for us to explore and slice this data and understand why those mortgages are not performing, and where these markets can develop to target certain segments where we can see them bringing down these NPLs. So on overall balance, the mortgage market is showing an improvement where we have started 10 years ago. For example, at IFC, we are deploying various tools under the World Bank Group, such as the mortgage refinancing companies. Like when you look into Tanzania 10 years ago, there were only about 3 financial institutions offering mortgages. Now there are about above 30 financial institutions offering mortgages. So the story and the results are encouraging, and we need to continue doing what we're doing with a couple of modifications to make sure that we really tackle the affordable housing segment. So I will end the presentations here.
Thank you.
Thank you very much.
Thank you very much, Maureen. That does set us up for a very interesting conversation, dealing with some of the key issues that you have raised right across the board on everything from access to financing, the tenor of these mortgages, where exactly are these mortgages going, the sort of performance of the portfolio as a whole, and I'm pretty sure we'll actually get into the details of that a little later. Let me introduce my panel for this discussion for you in a bit more detail. As I mentioned a little earlier, we're going to start this conversation with 4 specific individuals in it. Femi Adewale, the Managing Director and CEO of Family Homes Funds, Kisia Rust, the Executive Director, the Center for Affordable Housing Finance in Africa, Kaisa Mashifane, the Executive in charge of Residential Property Finance at Nedbank, and of course, Christian Agosa, the CEO of the mortgage refinance firm over in Togo. Let me start with a fairly broad question to all of you, because the answer to this is different depending on the market that we're looking at. Femi, what does affordable housing look like in Nigeria in terms of the cost of acquiring it and the size of the house that we're talking about? Femi, I think you're still muted. There you go.
Thanks, Ram. I think that's an almost impossible question to answer. If I was going to be provocative, I don't know that we have affordable housing in Nigeria. I pick up from Maureen's presentation. If we have 74% of Nigerians earning less than $2 a day, I don't know that the current house building market in Nigeria is building in any meaningful way housing that is affordable, which assumes housing that they can pay about $240 per annum or $20 a month for. We're just not doing that. Yes, we do have housing that is largely affordable to the small segment of the population which will be people who are eyeing fairly significant incomes. But if I was to answer the question directly, I think affordable housing for the vast majority of Nigerians will be very poorly built, informal housing in slum conditions, without power, without water, with significant damage to their health. That is the housing that is available and affordable to a vast majority of Nigerians on low income. And that is something that we're setting out to change.
Okay, you say, I know this is a slightly unfair question because you mostly deal with developers, but what does affordable housing look like in your market?
Look, I have to agree with Femi again. It depends which financial institution are you asking, which government institution are you asking, or which developer you ask. But at least we have some level of description. We, from our side, from a net bank perspective and from a CIB perspective, is anything which is less than 1.5 million rent in terms of, let's say, the sales price. And when it comes to, let's say, the rental, is anything below 8,000. However, that definition, okay, is from a net sales perspective or from a gross sales perspective, differs. Units below 1 million are more generally accepted as affordable.
Okay, so Kisia, you're coming in here next because you've got a much broader overview of the housing market that we're dealing with across several African countries. What is it? Is there a common denominator where we can say, okay, this is what affordable housing looks like now, and this is what affordable looks like that affordable housing that we're targeting should look like, say, in 2 years, 3 years, 5 years?
I think some of the answer with that also depends on who you're asking, because the bank will define affordable housing on the basis of what they're willing to finance. And sometimes that ends up defining affordable housing in a way that isn't actually not affordable at all. So what we do is we ask every year, what is the price of the cheapest newly built house that's being built in the country? And that's available for sale by a private developer in a development. And it's a bit of a rough figure. So we're really just testing the temperature. And I'm always looking for ones that are less than $20,000. Why that number and not 19 or 15 or 10? We made it up. But really looking at the spread, because there is quite a wide spread. But this year there were more countries, pardon me, where there were developments where the house was less than $20,000. And that is interesting because it's starting to get to households. But Femi's point, we really have to hold on to, because the majority of housing across the continent and even in urban areas is built by households themselves. And in many instances, because they lack the finance or the building systems or the relationship with the municipal development processes, that is poorly built housing. In some instances, it's quite nice. It varies, but it's certainly not operating at scale. We have to decrease the cost of housing dramatically, and I think that's the topic of this conversation. So I think we need to just keep on pitching below 20,000, and we're seeing some interesting houses and projects being delivered for below 10,000. Of course, state subsidy comes into that as well. And then one needs to think about the efficient, effective, and least distortive way of offering state subsidy so that you can build a market in that context.
Indeed. Christian, you operate within the West African Monetary Union. What does an affordable house look like in aggregate in the markets you operate in?
Thank you, Hama. The question is quite difficult, as it's been said. And if I go through the spectrum of the 8 countries, what we use to refinance as affordable housing is up to $43,000. In CFA, we say 25 million CFA. This is what is available in the market for household near the large capital cities, not inside the capital cities, but near the capitals in the suburbs, just to have a small home with price of land increasing all the time, and with at least an average sanitation facility. And I mean, this is basically what we can say. But now, the truth is also that when you go to Senegal, you can have various level of affordable housing for this price. When you go to Burkina Faso, you don't need so much money to have an affordable housing. But if you go to Abidjan, even in the suburbs of Abidjan, you may be lucky to find a house for this price. Cotonou is less expensive, like Lomé, but broadly speaking, that is what we call affordable housing when we lend money to banks to finance affordable housing for longer maturities, at least 15 years, with very competitive rates of 4.5%.
Okay, let me try and go down a little deeper into those specific factors and get us to that point where you're if you're essentially want to get into the property ladder, you're looking at maybe $40,000, $50,000 going up, depending on the market that we're looking at. I'm just picking that as a median point based on the data points that we've had in the last couple of minutes. Femi, as a developer, what is it that makes the cost of providing affordable housing essentially not invalid, but what makes it difficult to get to that low price point? Is it a cost of financing issue? Is it a building code and materials issue? Is it a land issue? What goes into that final cost that makes it difficult for us to provide quality housing, but also meeting the price point that makes sense within the economic context we exist in, where you've got a lot of people who are making less than $2 a day?
Okay, look, just about everything that you mentioned. The cost of land, particularly in places where people want to live. And I think that we should encourage people to live where, in places that are sustainable, is expensive. The cost of building materials, given that pretty much every key material is imported into most African countries, specifically Nigeria, doors, windows, tiles are pretty much imported. So every step of the value chain, regulatory compliance, cost of planning, cost of regularizing land, and every step of the way, even professional services where you bother to get one are expensive. But ultimately, the fact is that we're still building houses in 2022 the same way we built houses when I left architecture school in 1987. And no other industry is doing that. The car making industry is modernized. IT services are modernized. The construction industry just remains quite traditional, as industrialization and modernization appears to have passed it by. All of those put together means that we are building far much more inefficiently and therefore much more expensive than
But why is that? Is that industrial inertia, or is it a legal issue? Because I know if you're building a house, it has to fit within specific standards on the building code, right? So is it to some extent a legal issue, or is it just that the industry is like, hey, this works for us, we're comfortable, we have no incentive to change?
Well, I think I would argue that it's a political issue, and that would perhaps drag me to something else. And I think it's the fact that African governments as a whole, in general, have paid very little attention to the housing industry, and particularly the impact that housing can have on the economy. So you have, as we do in Nigeria, that our planning laws are absolutely out of date, which means that land, there's been no investment or support for local manufacturing of goods, no investment in research and development into new technology. All of these are left out to the market to make its ways. So I think fundamentally it lies in terms of political will to develop an industry that can transform our economies.
Okay, you say when it comes to this question of affordability, from where you sit dealing with developers, what are their pain points in developing affordable housing, and what would they like to see done to make it easier for them to deliver a house, say instead of that $100,000 level that we were talking about earlier, say at $50,000?
Okay, look, in every market where the housing system is working, you know precisely where you can build and where you can't build. You know how long it takes you to get planning permission, and you project for that. You know you have a secured supply line for key building materials, and the prices are stable. Just to give you an example, in Nigeria, the price of cement is tripled in the last 24 months. The price of reinforcement rods, probably about the same, 3-4 times over the last 18 months. Significant levels of uncertainties, and that is apart from the cost of construction finance. What that means is that developers are taking a huge amount of risk. They are pricing that, and therefore basically operating only in the segment of the market where they have a chance to make a tiny profit. And that is basically the 5% top end of the market. It means the bottom 74%, frankly, have nobody looking in that direction.
Okay, can you say in with respect to your market in South Africa, what are developers' pain points and how would they like them solved?
Look, I think our developers share the same sentiments which Femi just indicated. Firstly, it's available of affordable land and close to amenities or close to places of work for the end user. And everything just boils down to cost, the cost of contribution, the cost of bringing external services to the boundaries of the properties for those to develop, who incurs that cost. It's supposed to be, let's say, government, but in most cases, it's not taken over by government. It's funded directly by the developers as such. So it's basically the pain points for them is cost. And then moreover, recently, what has been more of a pain point, it's, let's say, the green element and then the cost which is associated with that again, which changed the dynamics, that it's not as cheap to provide, let's say, a green type of a development. But let me just not provide negatives. There's good programs in place whereby you find, let's say, government institution, your local authorities enter into land availability agreements whereby they give land through to developers, and then they provide those with development rights to build more of the affordable housing type of units. So there is progress, and we've been involved in, let's say, assisting and funding such type of non-conventional, whereby banks don't take bond over such properties because they're owned by the state. But we come up with innovative ways of, let's say, minimizing, let's say, risk associated with those transactions. And obviously, I think the most fundamental is, let's say, providing accommodation or providing housing, which is critical. But cost, if you speak to any developer, will come up with a cost element to it, that it's a high cost overall to provide housing.
Yeah, I should point out to our audience that Kisi has put out a link to some of the reports, some of the studies that they've done into the housing value chain in several different markets, Ghana, Cote d'Ivoire, Tanzania, a couple of others. There's a link to that in the chat box, definitely worth going into that. Kisi, coming to you. So it looks like a lot of these problems, or to some extent, a lot of these problems, land tenure, the cost of getting materials into and out of the country, spatial planning issues, because people want to live in certain places, but are the amenities actually present? A lot of these issues seem to boil down to, are governments actually doing what they need to do to make it easier for people to actually get access to affordable housing? What are you seeing any interesting projects, any interesting ideas in some markets to actually make that dream of affordable housing a reality?
Goodness, gosh, so many governments are trying to do it and address it, through different policy interventions. And perhaps The most important thing for them to do in the short term is policy clarity. So we've got lots of countries where policies are still draft. They haven't been finalized. And so the developer doesn't necessarily know what's what they can rely on. There was a comment in the chat that said, affordable housing must be subsidized by the government and must be government housing. And while government subsidies towards housing is important, I think we have to face facts that they don't have enough money for the scale of the need. So some level of subsidization, cool. And in South Africa, I mean, our government really subsidized affordable housing for the last 25 years, and we still haven't resolved the problem. And I think what we failed to do effectively enough is actually make the market work so that you take the barriers to entry away from a range of developers, including small scale developers. So when a government engages, they have to make things clear so that the developers know what they're doing, what the terrain is that they're working on. And then they can apply a range of levers. Finance subsidy is one, but there are so many others in terms of the speed of development.
No.
That increases the cost. Then also in terms of just incentives about connecting the process, the development process, the residential development process to the other built environment development processes so that you build those synergies. Those are things that government can do. It's planning and it's engaging with developers to make the process easier. And I think that's where the real focus should be, to make things much more efficient. And they can do it now because we have technology that allows us to capture all of the information we need and to focus on the data. And governments are not right now, I think, well, none of us are investing enough in putting data into the hands of the investors and the developers so that they can make good decisions, which then reduces their risk, which then should improve the affordability of the development because they don't have to hedge.
Indeed. And I'm pretty sure we'll get to the tech bit in just a moment in a conversation with Dina. But one question to you, Christian, before we get into that. Given the informality that we see in many of our economies, the bulk of employment across most of sub-Saharan Africa is essentially in the informal sector. And access to finance is still a bit of a problem. Financial inclusion is not really where it should be in 2022. Are mortgages, strictly speaking, where we should be focusing on in trying to expand access to affordable housing?
We can, yes, I believe, because given our experience, we started 2 years ago to refinance mortgages by microfinance institutions. And we realized that there is a huge demand there for those people. And the fact that even low income and informal household, informal revenue people have the strong desire to have their own house, drives them to do whatever it takes to finance this mortgage. And it's very important to give them the right on the house, that they have the mortgage of their own, and the ability that is very important. We have started an experience on refinancing mortgages to low income and irregular income household since two years, and we believe that given the demand there, it's important to account for those people too.
Okay, we'll certainly get back into the mortgage discussion and the question around what the ideal financing model looks like, given the realities of how people tend to finance their construction. But I want to bring Dina El Kadri into the conversation. Dina, of course, is in charge of Alpha Credit. It's a fairly interesting organization. She's the founder and executive director of Alpha DigiCredit, and she's sitting pretty much in that space that we've been speaking about for the last couple of minutes. How do we bring tech into this space to actually fix some of these pain points that we're dealing with within the mortgage space. So Dina, let's start with the question of being a digital mortgage broker, trying to essentially expand access to this affordable, to get more people to get affordable housing. The concept is fairly well established elsewhere, but why hasn't this been tried before here in our continent?
Thank you, Rama, and thank you for having me today. First of all, in order to optimize access to affordable housing, it's essential to analyze the cost of the acquisition. It includes three main elements: the cost of housing itself, the financing cost, which includes the interest rate, like in Senegal, it's 7 to 9%, and the mortgage fees, around 2% of the cost of the house. The third element is the additional fees, like the notary and insurance cost, that can go from 14 to 17 of the cost of the house. I need to mention at the beginning that our platform actually is a hybrid concept that combines two types of brokers: real estate broker and financial broker. For the real estate brokerage part, we gather the best reliable real estate opportunities of the Senegalese market. This already allows to have a visibility 360-degree on the offers, a fair competition, which naturally forces actually the market to adopt a better transparency in terms of price. Moreover, our 60,000 visitors per month allows us to collect important data according to our customer needs. Real estate data, I'm talking about the typology of the properties, the most searched after areas, the average budget, etc. And the financial data, like salaries, bank commitments, and borrowing capacities of our client. This data actually allows us today to clearly analyze the local demand and to negotiate wholesale prices for our clients with the developers. We can also set up a tailor-made projects based on their needs, on the needs of our clients, their income and financial capacities, such as housing cooperatives, for example. This is, of course, explained by the fact that the promoter no longer bears the costs related to marketing, communication, and even financial costs, since he already has a guaranteed client. So this is the first criteria, actually, that made or can help us as a digital mortgage to support more affordable housing. The second one is, as we are a real estate credit brokerage also, we put in competition the different partners banks, which are willing to apply very competitive interest rates to acquire a new customer or even to retain it. So the rate is applied on a case-by-case basis, depending on the client's risk and not according to a pre-established rate as banks usually do. So in addition to that, we negotiate a long-term to have a greater borrowing capacity, for example, which translates into greater access to housing for low and middle income people. We also negotiate the unnecessary of the down payment, especially for the diaspora, among other conditions. The third point was the notary and insurance costs. Since we have partnership with the notaries and insurance company, we can offer our clients preferential rates, which allows them to have really a very optimized real estate acquisition from A to Z. Now, your question is why we don't have mortgage broker yet in Africa. Well, Alpha DigiCredit is a pioneer, at my knowledge, to take up the challenge of digital mortgage broker, because we believe it's the right moment. As the speaker said it before, in the current African context, we note a growing maturity of the sector with an increasing appetite of the banks towards the real estate loan. That I can say, you know, it's a product that builds loyalty in view of its lifespan. Also, the competition being tough, the banking procedures are becoming more digitalized for a faster decision making. The real estate market shows an increasing production of real estate projects. Even the social culture is evolving with the notion of becoming a homeowner, which is no longer reserved for a certain segment of the population. So for these reasons, disruptors, let me say, like Alpha, promote fintech and proptech to move the lines for a better ecosystem.
So how then do we deal with the question of what you raise? Because you've got all these fees that come up in the course of the transaction, right? You've got legal fees, you've got approval fees that will come up along the way. You've got insurance that has to come into the conversation as well. Yeah. So to what extent does a platform like yours lower the cost of the transaction for the end consumer?
Well, the question is quite legitimate. That's true. Why incur additional costs by paying a third party who will do things that you can do yourself. Well, to reason in this way is to really underestimate the reality of the market, the arduousness and the length of the procedures at all levels. Indeed, the broker has a wide visibility of the various financing offers. He therefore plays a role of comparator and advisor in the assembly of the credit file. He highlights the advantages of the financing demand and anticipates any reservations that the bank may have. By knowing how the system works, he will be able to defend the file and obtain preferential conditions for his clients without forgetting the time factor, of course, which thanks to Alpha, for example, we can give today an agreement in principle within 24 hours and in 7 days in notification of credit. Traditional banks can take 2 months or more to give an agreement in principle. So this is thanks to our knowledge of the market and especially the adapted scoring that we're using today. And just to give you a concrete example, for example, for one client that we accompanied recently, she applied herself for credit of $100,000, let's say. She received a proposal from the bank at a rate of 7.5%, which is a great rate, actually. It's a good rate. According to that rate, she will pay monthly $800. So thanks to Alpha's intervention, she was able to obtain a rate of 6.25, which means a monthly payment of $700, saving of $100 per month. And over the life of the loan, she will be saving $24,000. So not including, of course, the insurance savings. So at this point, I think it's relevant to note that, yeah, I need to mention, of course, that the client have paid Alpha for its services like $900, but we can consider that the use of a broker as an additional cost will actually is to have like a short-termism view of reality.
Okay, so one last question for you. You're operating in Senegal at the moment, and a couple of questions that have actually come up in the chat, and there are people asking how they can get in touch with you. What's your plan for scaling up across other markets within Africa?
Well, first of all, we want to stabilize our economic model because we have started just only 1 year. We're operational since 1 year, but the project is like, we're working on it since 3 years now. So we want to stabilize our economic model and then transpose it to West Africa, which has the same socio-cultural context. We have a license actually to cover the zone. We have the same language, the same financial institutions, and sometimes the same promoters that developed in the whole sub-region. So for this, we also work with the Bureau Information or Credit and Information Office, which is a central risk certified by the central bank, in order to have a credible scoring by client and to get an instant credit or an instant loan proposal with a personalized rate that responds to the client's own risk. I think this is very, very important. And this is a very, it's a great lever actually to reduce the cost of financing, because what's happening today, if like your salary, you will go to the bank X, you will have the same rate like all others, but your risk is actually different than the other profiles. So actually we don't give a rate depending on your own risk. That's what we're working on now, to have like lower rates and to have also like an immediate, an instant credit notification.
All right, perfect.
Yeah. Okay.
Thank you very much, Dina El Kadri, founder and executive director of Alpha DigiCredit. Of course, we've put in a link to her company, of course, in the chat as well. So if you do want to get in touch with her, you certainly can do that. I'd like to get back to essentially piggyback off something that Dina actually mentioned around the cost of credit. One of the clients that you mentioned in her example, they're getting access to a facility at around 7%. In doing some of the homework for this particular panel, I looked at mortgage documents from 1989. This is a slightly personal story. This was a mortgage application my parents had put in. And back then, their bank was offering them a mortgage facility at around 28%. Sky high numbers. Today, if I get into the market here in Kenya, I'll be able to get access to a mortgage facility, if I'm good, maybe 11, 12%, 10 to 15 years. And this ties into a question that was asked a little earlier before this conversation started, where someone asked, look, you've got a situation here where I believe this was, let's see, Michael Abukan, our Belton Property Development CEO. And he asked, you've got a situation where in Europe and in the US, your mortgage rate is in the single digits. But in most of our markets, in Kenya, in South Africa, and a few others, it's in double digits. Why is that? What goes into that particular number that we eventually do see? Christian, let me start with you, then I'll come to Femi.
Well, I can offer a general explanation that monetary policy is not the same in all area, and that we do not start with the same level of saving or already built wealth to work on. But back on our own experience, you're right. When we started working in, 10 years ago, mortgage rate was effectively 2 digits, roughly 14%, maximum 10-year maturity, and you may be very lucky to have a 10-year mortgage in our area here, maybe except in Senegal by this time. But for all of the other countries, you just benefit from small loan to achieve your house, to finish your house, because you have built the house on revolving short-term personal loans first before. So when CAGR 8 was created, it was just to provide long-term liquidity for banks to help them develop the mortgage market. So we start by on lending them money for 10 years at 6.10%. Then we move to 12 years at 6%. Finally, 15 years at 6 or 5%. And globally, we have issued 8 bonds since then to on-lend money to banks at very competitive rates so that they can finance mortgage. And now today, in our area, average mortgage rates range from 7% to 9%. So it's 1 digit, but it's still above European rates. That's true. So we need to have facilities to promote long-term financing on large scale. Plus, government should work also to develop the tightening systems. Many other schemes that can make banks more comfortable, and lowering the cost of recovery, so that it will be cheaper and cheaper for banks to lend mortgage, to send mortgage.
Right, Femi, if I may come to you on this, because we had this discussion last week, and you had some fairly strong views with respect to the question of how do we make it easier for people to get onto the property ladder, and you're very adamant about the role that government subsidies can play in that space. But in a market like Nigeria, would setting up, say, for lack of a better word, the equivalent of a Fannie Mae or Freddie Mac in that market, would that be the answer, or do you have a different set of subsidies that you have in mind? You're muted, Femi.
I think there's a lot of things we can do, and I think there's a lot of very, very useful interventions. But I think that for the purposes of this conversation, and particularly because I think is one subject that is not often discussed, I think that a big area of innovation is talking about what government can do to subsidize access to housing, particularly for people on low income. Let me just play with some figures very quickly. In our presentation, Maureen said 74% of people across the continent, I think that's pretty much reflective of Nigeria, earn less than $2 a day. So that means they earn about $70, $720 a year. If they spend a third of that on their housing cost, they have $240 a day to pay for housing. Now tell me, what kind of house you can buy for that sort of financing. I just did some very rough calculation. Even a $10,000 house will be way, way out of the affordable means of that population. And that is 74% of the people. So for me, it's about clarity. If what we want to do is house the few, the top 10%, I think there's a channel. If what we want to do is even house the top 50% in the market, there are very big discussions to be had. And I think that the issue of subsidy must be part of those discussions. Now, the question is what kinds of subsidy is affordable to government, but also helps people on low income to achieve housing. And you have a huge range of designs of subsidy that is both affordable and sustainable that we can talk about. But in terms of your question about the cost of mortgages, for example, one, cost of funds. So in Nigeria today, a commercial mortgage will cost you the upper teens into the early 20%. What is the factors driving that? 4, 5 ones, the cost of funds. In the marketplace, mortgage providers are competing with government, which is equally borrowing. So of course, that is sucking out capital into a risk-free environment. Law of demand and supply, it means that you're buying your money for much cheaper. Tenures are very, very short, but also risk. Again, in our presentation, Maureen kind of highlighted outside of Namibia, South Africa, in Nigeria, default rates on loan is as high as 20%. I think that figure is understated. So that risk is priced in, and before you know it, you're looking at the upper 20s. Then
if I may just distract you briefly there, Femi, we're talking about 20% default rates, and yet the bulk of this lending is going into the end of the market that, at least on paper, has the ability to actually pay for these things, right? That's essentially this narrow upper band of the market, and yet we're seeing these high default rates over there. Why?
Good question. I think all of the sociology shows that people who are high income, who have choices, are under pressure, are well prepared to lose their homes because they think they can get another one. But actually, contrary to what wide perception is, people on low income place a huge amount of value on their home. And I think they are not disposed to default except it's totally out of their control. And I think that that behavior is driving, of course, apart from operational issues about poor lending policies, poor lending practices, is leading to what we see at that end of the market.
All right, Kisi, I know you wanted to come into this conversation around subsidies because it's one of those that we have to be slightly nuanced about. It can't be just saying outright, no, you can't have subsidies at all in any given market. We do need to get more people into the housing market to get affordable housing to as big a percentage of the population as we can. But what's the optimal way of doing that?
So my hesitancy with the subsidy conversation is that it creates the opportunity for abdication. And I think the thing that we really need to do is segment the market. In order to be able to define what government can do and what the private sector can do and where, this market is so much more nuanced than rich and poor, right? There's a whole lot of other things that can happen. And if we're talking just about the delivery of a whole house, Femi is absolutely right. The vast majority of that population will not be able to afford to buy a whole house all at once with a mortgage loan. They have neither the quantity in terms of their income, nor is the structure of their income appropriate, because they would be earning it informally from multiple sources and so on. So we really have to spend some time to look in a lot of detail at demand segmentation to really understand the demand side. Then we design our instruments, whether they are financial instruments or housing instruments or policy instruments, to respond to that nuance of demand. And that relates to, so within the financial sector, I would like to see, and there has been some really interesting work being done on how do you underwrite for informal incomes. And that, I think, is what Dina was speaking about. And those opportunities within the technology offers to really begin to understand clients. And if you can start to do that, then on the supply side, you would look at ways in which you split up your housing delivery process into pieces, and pieces that are both financeable, so connecting well with the financial sector, and also connecting with the municipal planning system so that they are formal, and happens incrementally. And that is both a policy and a regulatory question, as well as then linking that conversation with what the private sector can do. Again, recognizing that each player is playing a part of the process with the household themselves. If you start to segment like that and you get much better information, you're also then creating the argument for who can afford and participate in what way, which then should be able to the mortgage rate question, start to reduce some of the spreads that are being applied between the cost of funding and what's actually being lent out, given the perception of risk that exists in an unknown market. I have to say all of those things because the government, if we just say subsidy, and Femi, I'm completely with you, we do need government to recognize that they need to invest in affordable housing. Absolutely. But if that's all we say, what ends up happening is that the private sector says, no, government deals with that and we'll deal with these people, this 5%. And in fact, they need to figure out a way to work together. And the government needs to target that segment of the market that private sector really cannot address. So by segmenting, you narrow the focus of the particular players so that they can engage more productively. So I would argue, and I've said this, but the data question is critical. And everyone on this call, whether it's our co-panelists or all the people listening, I would love to share your data because we're all operating blind. And we need to be able to share it to really understand the market we're working in and to develop the appropriate policies as well as products and services to engage with its diversity.
Now, Femi, I should give you time for a quick rebuttal and then we'll go to Christian on that.
Yeah.
I think there are no rebuttals. I think Cassie and I are one on this. I think that subsidies can't be a silver bullet, but I just think that it's an orphaned child because it's been stigmatized and is not being talked about. And I think that perhaps the most critical financial innovation that we need to have is looking at how we can deploy subsidies in a clever, sustainable way to both motivate the private sector to deliver for the larger population. So for example, look, if you're raising capital on the market today, you're having to pay all sorts of taxes and government fees. So that itself is withholding participation of the private sector. How about a structure that actually provides tax waivers if you are developing houses as a private sector developers for people at that bottom of the ladder? And it's a very big, 74% of the population. Within that are sub-segments. But I think that discussion needs to be on the table. I'm quite adamant about it because the disposition has been, don't talk about subsidies. Subsidies are bad. And I think that is absolutely wrong. Every country in the world that has a functioning housing market is investing heavily public money. The US government is spending in 2021 $92 billion in housing assistance program. Of course, African countries can't afford that, but we need to do a lot more than we're currently doing now. And let me end with this, and I give an example of Abuja, where I live and work. All of the residential areas that are in the town, in the center of town, Maitama, are up to 40% either empty or under occupied. And where the majority of the population live, often miles away without infrastructure, without transport, are over-occupied, overcrowded, poor accommodation. There's a social issue there that gives a room for taxation to fund affordable housing.
Christian, where do you stand on this question of subsidies? Because yes, as Femi has rightly pointed out, if you've got a government that's borrowing as aggressively as they do, at least in some of our markets, in Kenya, in Nigeria, is certainly the case. Bankers have an incentive to simply put money there, right? Get your 10% with a relatively low risk, and not essentially turn and commit that for 10 or 15 years into the mortgage market. Where do you stand on this question of subsidies?
Thank you. Femi makes some points, and he also provides some. Same time he provides answers to the point he raised. The core of the problem lies in the sustainability of the subsidy schemes. Our government, most of the time, use to subsidize housing. If I take a country like Senegal, subsidizing housing has been a practice for long until the country ran in problems in the 80s with the IMF and the World Bank. And with that comes the structural adjustment programs that eliminated all of those housing subsidized schemes. The same goes for Ivory Coast, and a large part all of the institutional structure, the institutional framework that regulated the government subsidies to housing were dismantled. Now we are in all of those countries in a new effort to rebuild the housing financing and the subsidy scheme, and we need to design the most sustainable schemes that can help build affordable housing with people that can also provide scale to take to benefit the most of the subsidy schemes that are put in place mainly for land, sanitation, so that developers can benefit from low-cost land to build houses at cheaper cost that people can really afford. But there is another point. Do we really need to work to get affordable housing at the door of everybody, and all of the low-income people? I believe that we should account for the fact that not everyone needs or wants to be a homeowner. That people sometimes can be at ease with a rental scheme. And we need to provide also those people with schemes, framework, including subsidy schemes that can help them live in better conditions than what we can find today in our in the slums in most of the capital cities of our countries. That's just my take on the subsidies issue.
All right, I want to move the conversation forward. Keisia, let me come to you with a question of data. I want to pick up on something that Keisia mentioned a little earlier. We're flying blind, I believe was what you said, with respect to understanding how, especially the demand side, who wants to buy a house, what can they afford to buy, etc, etc. So from your perspective as someone who finances developers, Keisia, what more data would you like to have to essentially have a better understanding of what demand looks like? Or more accurately, do we already have the data? We just need to understand and analyze it better to get better insights essentially in real time.
I think data is there, it's available. However, one thing is how do we use the data insights which we have to effectively change the industry the way it's supposed to. And I just want to just sidetrack just a little bit to talk about what Keisha has spoke about earlier about market segmentation and subsidies in South Africa. I think, and she alluded to that initially when we started. South Africa has been subsidizing heavily the specific market. You've got grant housing, which is our BNG housing. You've got SHRA, which provides, let's say, rental assistance or rental accommodation for those who earn between 1,500 and 15,000. You've got FLIPS in terms of providing, let's say, finance link type of subsidies to individuals. So there has been a whole lot of subsidies, and the demand is just way surpasses enormously so the supply of housing in SA. But one thing which I think we need to change the way we approach the market. For example, we've got backyard rental dwelling, which has been predominant in SA, but banks haven't, let's say, taken cognizance of that and then of funding that. But this is a new product which we are now, let's say, looking heavily on. And I think that in a case will provide, let's say, decent accommodation to alternative accommodation to the end market there. And rental is an option, and not everybody has the credit scores, as you've indicated, that they can qualify for the mortgage. The other issue, again, I think is the participation on end user financiers in funding only land and not top structures. I think housing, again, we look at it as a service land with top structures, and we call it, let's say, a formalized type of housing. But we've seen that there is a huge demand for land which is serviced, and the end user or the ultimate client will go for unsecured lending out there to build their top structures. So that's not only we need to change how we focus on how we look at this market. But data insights, I think, are critical. As I've indicated some time ago, last week, is that the currency actually is just its currency. We use it for our own benefit. But I think at some point we need to be able to, let's say, have a common understanding in terms of what we share, because as it is, I think all financial institutions are using it as a base of a competitive advantage more than, let's say, for research purposes.
Let me pick up on something that you mentioned, because it's similar. There's a similar trend even in East Africa, because what you'll find out is, like, Kenya's an example. Population of 50 million, mortgage accounts are around 27,000. A lot of the people in my age group, my parents' age group, a lot of those individuals finance their houses through a lot of unsecured debt. So I'm going to essentially suggest something that's a little heretical here, because you're in the banking space, but should we even be talking about mortgages when it comes to expanding access to affordable housing? Yeah. Because the way people are financing their homes now is completely different.
Exactly. And again, it's data insights. Are we using the data insights which we are collecting to change the way we look at how we fund this product or how we fund our customers? Probably not. And hence, let's say, the emerging banks, which probably, let's say, predominantly concentrate on unsecured type of lending, flourishes, is because that kind of financial instruments are suitable for the customer needs at that particular point in time. Or what I'm saying is land which is serviced needs to be financed at a longer term by financial institution, and we look at how, let's say, we provide, let's say, top structure funding. And for that, I think you can be able to address a huge issue which we have in terms of shortages of housing in anywhere in, let's say, Africa.
Working with what we have. Kisia, I want to give you the right to reply, and then I'll go to Christian and ask him a little later of how, if it's even possible to be refinancing that sort of debt. But Kisia, you first.
Just a quick comment, actually, is just to say, I mean, housing microfinance is very important. Non-mortgage housing finance is important for incremental housing processes backed it's going to be more expensive because it's unsecured. And so why would we do that to low-income people? The benefit of a mortgage is that it can reduce the interest rate because of the security when everything works. When it doesn't work, it's not working, and there's a whole lot of else you need to look at. But really, we can't just segment the market and say, well, poor people, they got all this extra stuff or all this particular special things that are more expensive and not offered by, by mainstream players. And it's only the rich that get access to the good products and services. We really have to challenge ourselves to make it possible for low-income people to access products that have very low interest rates, that are benefiting from a functioning land market that allows you to properly underwrite that loan and expect you'll be able to get it back.
Let me just,
Keisha, go
and
ahead.
I agree with Keisha totally, that we need to provide, but access to funding because of credit scores is an issue. Not necessarily more of people cannot have surplus income to afford. It's just historically they have bad credit scores, and that is used to reduce their ability to get funding. And when it comes to what do you call this, unsecured, it's purely looked at on your income. And not necessarily, I'm not saying that a score doesn't count, but purely on your income. If you're working, you can produce, let's say, a form of a pay slip, and that is much easier to provide. And obviously, it's because of its short term instead of long term. But I totally agree with what you said.
Keisha, but just to throw a little spanner into the works, I mean, if it comes down to a question of access, I mean, even to use my market here in East Africa as an example, $50,000 over 5 years is going to be a hell of a lot cheaper to access than the typical $80,000 mortgage over 10 or 15 years. And inevitably, once that's paid back, the total amount of money that I'm paying back to the bank is a hell of a lot higher. So, the math for a lot of people here will be, look, if I can get the unsecured loan, I'll go for that and work with that, and, all else can sort itself out. Sorry.
Why don't you secure it over 5 years for a $50,000 loan? I mean, we're talking here very low loans, not 50,000. I'm talking a $10,000 loan, $10,000 mortgage. These are micro mortgages, if you want to say that. But in South Africa, very highly financially included population. But there are banks now that are offering $100,000 mortgages. $10,000 mortgages, 100,000 Rand mortgages, 150,000 Rand mortgages, because that's the market segment that we're working in. And then those households are going to benefit from the interest rate that is possible because you're securing the property.
And
they should be shorter term. Absolutely. I agree with that too.
And this is me speaking on behalf of bankers, although I really shouldn't. But their main concern here is around land tenure, security of title, and so on and so forth, which is a problem that is present in a lot of our markets. Yes, I've lent this money out, but even if you give me this title deed as security, do I actually know that it's legit? What are the odds that some other person will come up and demolish the property 5 years from now, 2 years from now, 10 years from now? That's a real problem.
That's what the government needs to fix. That's a huge barrier. Absolutely.
Yeah. Christian, where do you come into this conversation around refinancing? Because as Keisha points out, a lot of the money that goes into real estate is not, actually structured as a mortgage. A lot of it is unsecured debt. But what, from your perspective as a mortgage refinancier, are those funding streams that you'd be able to actually tap into to refinance, or would you stay out of it entirely, and why? Walk us through your thinking there.
Well, it's true that a large part of housing financing is not based on mortgages, and we believe that it's not a good thing, because when people invest in the house for a house, we should make sure that they have a real security. They have an asset for their own, with all of the rights that go with it. It's of no interest to I mean, for a father to spare money to build a house that can be demolished by a flood, and he ended with nothing in hand. When we started refinancing microfinance institution for housing, we supplement our refinancing with capacity building, so that those institutions may be able to identify all of the appropriate steps to make a mortgage and to follow the new household, I mean the borrowing household, to achieve the whole steps of formalities to have its title and the mortgage that comes with it. That's the way we proceed. We offer technical assistance to build capacity, so that on lending money to microfinance institutions and low income or irregular income households does not boil at the end to a simple, I mean, a house of sand. We don't want them to have a house of sand. We want them to have a real house with all of the rights that go with it, and on the longer maturity, so that the installments are cheaper and bearable for them.
Right, absolutely. That makes a ton of sense. I just want to go into the last segment of our conversation around building green. Yes, there's this huge demand for affordable housing across a big chunk of our markets. Fair enough. And I want to build on a question that was sent in a little earlier by Betty Wilkinson from FST, Financial Sector Deepening Trust. And she asked, with respect to housing finance, how do you certify and monitor what is green housing? And if I may build on that a little bit, should we be talking about green housing in a context of trying to get as many people into the affordable housing market as we can? Femi, let's start with you. Your thoughts on green housing. How do we build them? How do we monitor them? How do we certify it?
Okay, first, look, I come from the view that the whole notion of green housing, I think, is essential. While taking care of the present, we have to keep an eye on the future. So it's absolutely essential. I think the key thing is how we do it. And I think that there are two key things I'd like to see in advancing the discussion around green housing for Africa-centric housing. And the first is, what does green housing and the standards that are associated with it mean for Africa?
Indeed, because I guess a question that some may ask is, if I slap a couple of solar panels onto the house and have part of the power feed coming from the sun on a regular basis, does that quote unquote make it green? I mean, it sounds very vague.
Absolutely, and I think that there's a lot of work that needs to go in, and I'm glad to say that the Family Homes Fund is well into that piece of work, actually defining what does green housing mean for affordable housing in Nigeria, and creating a standard which we will engage with some of the big major certifying agencies with, and then build to that. I don't think that some of the Europe-centric standards are quite applied to us, or are indeed are realistic to what we have. So that's the first one. The second one is about investment in education, in consumer education. We need to invite, in a very sensitive way, the market to think long-term rather than short-term, as attractive as that might be, to understand that the fact that a small investment in protecting themselves from what is undoubtedly a looming energy price hike is a sensible investment to make now. So for me, is defining an appropriate standard relevant to a market and two, educating the public.
But what does that look like though in your framework that you're working on now? Is it just a question of solar power? Is it that essentially provides say 50% of the powers of the households rather energy needs? Is it related to the materials, the construction materials that are being used to actually build the house? A certain percentage needs to be recycled. Walk us through what sort of metrics you're looking at.
Yeah, so just some key metrics. One, water. So part of the key aspects of our standards is ensuring that we have what is called rainwater harvesting. So that's harvesting surface water, storing it for reuse. Quite critical because we have a looming water shortage problem. Another key standard to look at is simply the orientation of buildings to ensure that you are capturing the buildings are oriented in terms of the movement of the sun. So you are minimizing heat gain into the building and heat loss out of the building. You know, that's kind of a principle of tropical architecture, which has been forgotten over the last 20, 30 years. So that's the second standard. Third, yes, of course, is with improving technology, we now find that solar panels are becoming much more affordable and provide alternative sources of power. The fourth bit is just purely insulation to the roof, again, to reduce solar gain, which then necessitates you having to cool the houses at an energy cost. Those are the key areas that we're currently looking at.
Okay. Can you say, do you want to weigh in on this? What does green housing look like? And is it something that developers on your end of the world are actually paying attention to now?
Most definitely. And from my side or from our client's perspective, it's something which cannot be ignored. It's long-term objectives, for example, just to give a code, which is from the UN Enviro Program, which was April 2021. They just stated that the real estate contributes 30% of the global annual greenhouse emissions and consume around 40% of the world's energy. And obviously, it's by far the biggest asset class in the world. It's real estate. So in the long term, I think it's unavoidable for us to continue and persist the way we should be doing. However, our developers have indicated that the greening cost element makes it unaffordable. It's into their their profit margins. So how we look at that in terms of, let's say, the banks, it's to try by all means approach DFIs, get cheaper funding, and which will enable to incentivize the greening element and the greening cost to a certain percentage, which in turn will be able to encourage developers to participate into this segment. Most of our developers are, in general, building according to the green elements. The only thing which they don't do is the certification part of it. Why is that? It's probably, again, is the cost element to it, which they think is just way above board, and then it takes away their margin. And another thing
but
which
if I may ask,
also indicated.
Is that certification bit is that certification bit problematic partly because it's not necessarily delivering a return to them? Because a lot of the things that we've spoken about, rainwater harvesting, well, in some parts of the world that's pretty much standard. Putting up solar panels on your house, trying to reduce your reliance on the grid, again, also relatively standard. So, you know, from the perspective of a developer, if you say, okay, yes, this is a greenhouse and yeah, I'm certifying it as such, but what's the benefit for me as a developer?
It's true. But again, there is a social impact over the long term. And there is two aspects to it. Your end user ultimately has to benefit. And there is an environmental aspect to it. But if you are just, let's say, concentrating on just a pure margin perspective, in the long run, your own market won't be sustainable to start with. But nonetheless, what I was saying is we are able to facilitate, let's say, incentives. That's what we bring into a board and make it just more affordable for our developers. But the issue, again, is the data insight which we derive from the greening aspect. Currently, there is not that much of a differentiator in terms of valuation of the assets, whereby a unit which is much more green is much more expensive or much more affordable as compared to a conventional greening. So from a rig-year, or if you are holding a property as an investor, that again, it doesn't give you the financial benefit in terms of, let's say, your current utility cost or funding cost as such. So those are the elements which I think it evolves, but there is much more of an environmental and social impact, which is much more purposeful than the ultimate just profitability. But again, understandably so, the certification part of it, it's a cost which we need to look at very closely.
Kezia, you want to weigh in on this before we start into our Q&A?
Just a quick comment on it, I think, is that so IFC Edge certification is what's used mostly, and in terms of access to DFI funding, when the IFC provides funding for green mortgages, it's based on their certification. So it's not accessible if you can't get certified, or if you don't certify. And that's an issue perhaps for some developers who the certification itself is expensive, but it also is in terms of when we're looking at really affordable housing, really low down market. I think that there is space to work with Edge about certifying different low income housing processes. For example, developments that have no parking, because they're identified as developments that would be used for walking, or recognizing that there's much lower water use among low income people because they're conserving their services charges. So they may not have that special green tap, but they're using less water, so there isn't tracking around the consumption side. There's a wonderful case study that needs to be written up fully, which is International Housing Solutions had a project in South Africa. The same developer built a green project, and well, it was first a not green, I guess a normal project, an original project before green certification, and then the identical project they did down the road, but with the green elements, and they've started to track the operating costs. And that's where it gets really interesting, because in fact, the upfront capital cost investments save the household the equivalent of 1 month's rent every year on what they saved in terms of the servicing charges. And we need to be able to publicize that and share that and show the math, so that the developer can see, in fact, what's in it for the developers. They're going to have A, access to capital, and B, they're going to have buyers who will be able to, more buyers who will be able to afford their products.
Indeed, I'm looking forward to reading up on that. Perhaps we'll eventually see it on your platform, Kezia.
Hope so.
I'm going to get into the some questions from our audience, but this one should be particularly interesting. I'm going to start with you, Christian. This is from Jessica Schnabel. She's a global head of IFC Banking on Women. Do you have any insights about the performance of women borrowers in the mortgage portfolios that you refinance? This is particularly interesting. I'm actually keen on seeing what the data looks like on this one. Christian, what does your data set say? Are women better borrowers than men are?
Thank you. Usually, women are considered as better borrowers, and what is important for us is that extending mortgages, helping to extend mortgages, we are sure that, especially when it comes to low-income people or informal revenue people, we are sure that we will cover a large proportion of women in this area, because most of the time they are the one who runs those proximity businesses in the cities or in the markets. They are able to pay a good rent every month, but banks are reluctant to lend them money for mortgages. So they are an important target for us, and we are in the midst of reflection to see how we can extend our reach to women, especially in the low-income and informal sector.
Okay, Femi, I'm going to combine two questions from our audience for you. One is from Claire Lepourier. She's asking, could we have more information on the rent-to-own model and how that's working out? And I'm going to combine that with a question from Caleb Dengu, the managing partner at CDF Trust BV. And he's asking, how can we divide a housing unit into tradable tokens that can then be sold to informal workers so that, say, once a person has accumulated enough of these tokens, then they can essentially get a house? Yeah, okay.
Thank you. So let me take the first one. Actually, what we have is a product called the Help to Own, and essentially is providing people on low income with an equity loan, a deferred equity loan, that then limits the amount of borrowing they can take to what they can afford. So that gives them a step into the housing ladder. And obviously, as their income increases or the value of their homes increases, they're able to pay down on the equity loan. The maximum equity loan is 40% of the purchase price. And that's a program that we're currently working on with funding from the African Development Bank and a number of commercial banks and mortgage institutions in Nigeria. In terms of the token, that is not something that we have looked at or done. I think something similar to that is offering Nigerians in diaspora to crowdfund or invest in single or multiple housing units that can enable them to hold housing stocks that are managed for investment and get return on them. So again, because of that inflow, the relatively cheap source of that capital, it enables us to be able to house people on low income at a much cheaper price than the commercial price.
Indeed, I should also direct our audience to from Kisi in the chat. We should check out Empower, which is basically what they're trying to do. empowa.io. The URL for that, of course, is in the chat box. One last question here for you. This is Dina, if you want to weigh in on this one. Mariam Yeo, she's in charge of investments at the African Development Bank, I believe. And she asked, how can fintechs and digitalization help banks, help improve banks' lending into this segment? You've already covered what you're doing as Alpha Credit, acting as a mortgage broker. But beyond that, what else? What are the so-called untapped low-hanging fruits that tech can be used for to essentially make it easier to lend mortgages to as many people as possible?
Okay, so basically what we're doing here in Senegal, for example, as we are a very specialized team here in Alpha, we are for 80% of our team are ex-bankers specialized in mortgage loan. So what we do with the banks, or how we can help them to sell more their loans, that's the question, right? Yes, yeah, is that we build with them actually very customized loans. The banks actually here, like, they don't have a very customized loan for the diaspora, for example, or for the salary people, etc. So we work with them to build that kind of loan, standard loan, which makes us actually more efficient when we want to lend for someone. When we have all the criteria already identified, we know that every person who will, be in that criteria or will, like, how do we say it? Fill those criteria actually can have the loan. So actually, we're helping the banks to decide very fast on the loans demand. This is for one. Also, we're doing some formation. So we go to the banks and we can, like, give internal formation to help the bankers there to know better what are the demands of the client and how we can help him more. And also what we do is basically on a period basis, we can give them the feedback from our clients. Like, for example, the diaspora, we know we have partners that, bank partners that they want to give loans for the diaspora. But we as Alpha, we know that the diaspora have like a very important, like a constraint, which is the personal down payment, let's say. So they don't have it. So we help the banks actually to have a real idea or a clear idea about the reality and to adapt those criteria to the reality, so they can sell, let's say, their loans more efficiently.
All right. We're going to wrap it up at this point. We've been running this conversation for the better part of an hour and 40 minutes. And I'd just like to say thank you very much to all our panelists and, of course, to our audience for making the time to be here, for your engagement in the debate with all the questions and comments you've been giving us in the chat. Femi Adewale, Sima Shifane, Kisia Rust, Christina Gosen, and, of course, El Kadri. Thank you very much, all of you, for your time this afternoon. Just one quick reminder, of course, to our audience about that event that we're having in the middle of the year, 13th and the 14th of June for the Africa CEO Forum, our flagship event. You can, of course, register with the little QR code at the bottom right of that presentation, of that particular slide. You can grab a screenshot of that. Alternatively, go to the Africa CEO Forum.com. Hopefully, we'll see you there in person in Abidjan. After the last 2 years, it certainly would be fantastic to see everyone in person and talk face to face after a very long time. Ladies and gentlemen, I've been your moderator for this session for the last hour and 40 minutes. My name is Ramanyan. Thank you very much for your time and attention. We've been talking about affordable housing. Hopefully, we'll see you in our next conversation in the Africa Financial Industry Summit Series. Thank you very much. Have a good day. Bye-bye.